I'm going to talk about two issues which are often kind of do not receive a lot of attention when we talk about financing development or financing development in Africa. So one is the political economy, that is, I'm trying to bring the politics of finance in here. And the second issue is the role of central banks as economic and political institutions in financing development. So there is, as we've heard already, there is a growth momentum in Africa, and central banks certainly play a very important role in sustaining this growth momentum. For instance, because they shape macroeconomic stability, inflation, they influence financial stability, and they also affect financial deepening, that is the level of financial transaction that takes place in an economy, and hence access to finance, and so they have an important role in supporting investment in Africa. Studying central banks' role in the economy is very exciting at the moment because it's a very dynamic field. In recent years, the expectations towards central bank in supporting the economy have been rising, and also the pressures on central banks to support economic development have been rising. And so their mandates have become bigger in recent years. And this picture from The Economist in an article called The Grey Man's Burden kind of encapsulates this trend quite nicely. So the central bank mandates have become bigger globally. In many developed countries, what we see is that for some years ago, the main focus of central banks, or the main objective, was to guard price stability. But in recent years, many central banks have formally embraced the objective of guarding financial stability as well. And also in Sub-Saharan Africa, which I will refer to as Africa in the following presentation, this mandate of central banks has become bigger. So for quite some time, there was broad agreement across Africa that central banks should focus on guarding price stability and financial stability, and any other objectives should play a secondary role. But in recent years, many central banks have embraced the role of financial deepening and financial development as well. So, for instance, a study by CGAP has found that a large percentage of regulators in Africa have a mandate for financial inclusion. So a large percentage has, for instance, in place a financial inclusion strategy, and many have designated units for financial deepening. And this percentage is, as you can see here, higher than in many other developing countries. And the same survey also finds that in a group of 33 Sub-Saharan African countries, more than 70% see themselves as having a responsibility for the promotion of rural finance, and more than 60% have a responsibility for the promotion of SME finance. So their mandate has become bigger. And in fact, that's not a new objective or a new goal of central banks in Africa. So during the 1960s and 1970s, there was a consensus in many African countries that public intervention is an important means of financial deepening. However, central banks had difficulties in striking a balance between their mandates for price stability, financial stability, and financial deepening. And in many countries, they emphasized financial deepening at the expense of price stability and financial stability. And the outcomes are well known. So many countries experienced high inflation, hyperinflation, and severe banking crises. In recent years, as we've already heard, for instance, in the case of Zambia, this has changed. So in many countries, price stability, and financial depth have been enhanced over the past decade. And one reason for this is central banks' greater success in balancing their multiple and at times conflicting mandates. So monetary policy has become more focused on guarding price stability in recent years. Regulation and supervision has been strengthened. And in many countries, more recently, more from the mid-2000s onwards, there have been financial reforms aimed at financial deepening, financial sector development. The question which arises then is whether this progress of African central banks and striking a balance between their multiple objectives will be sustained, similar to the question of whether we can actually sustain the growth momentum in Africa at the moment. And I'm not really here to make predictions about central banks will will be able to sustain this progress. But I will focus on one factor that we should take into account in actually thinking about whether central banks' progress in balancing multiple objectives will be sustained, and that is the drivers of progress. And we know very little at the moment about what actually has driven central banks' progress in balancing their multiple objectives. There are more and more studies coming out which look at the relationships between policies to pursue price stability, financial stability, and financial deepening. But we know very little why central banks choose trade-offs between their objectives in certain ways and what has actually driven the improvements and the reforms that have taken place over the past years. And I will draw lessons from Kenya, Nigeria, and Uganda to shed some light on the factors which have driven the central bank's progress in balancing their multiple objectives. So I focus on these three countries because they actually made some progress in balancing the central banks made some progress in balancing their objectives in the sense that they have moved towards pursuing the goals of price stability, financial stability, and financial deepening together. And they have increased the emphasis on goals which hitherto had been neglected. I also focus on these ones because they have the ability to pursue independent central bank policies. They are not part of a monetary union or so. And because they exhibit some variation in the structural characteristics that we find across Africa. So Kenya, for instance, has a very diverse and relatively developed private sector. Nigeria has a rapidly developing and very dynamic private sector, but the economy still relies very much on oil and gas. And in Uganda, the private sector is also developing rapidly, but the economy is still reliant on foreign aid. And in examining the drivers of the central bank's progress in balancing their multiple objectives, I will build particularly on key informant interviews, which I did with policymakers, that is central bankers, donors, including the IMF and the World Bank in Kenya, Nigeria, and Uganda, and researchers. And the idea was to get a sense of in what ways the central banks have made progress in balancing their multiple objectives, what are the priorities of the central banks now in terms of their policy objectives, and what factors have driven this progress. And I'll also build on the political economy literature, because we know both from people who were involved in reform processes, like policymakers or donors, and from the literature on economic policy reform, that often political factors are important to sustain reforms. So I'm talking a little bit about the contours of the progress central banks have made in balancing their objectives. Then I'll say something about the drivers of progress in Kenya, Nigeria, and Uganda, and then I'll conclude by saying something about the prospects for sustaining central banks' progress in balancing their multiple objectives. And just to give a preview, what I find is that these countries actually have made progress in balancing the objectives, but there is really no room for complacency because there are substantial challenges to sustaining this progress. And so it's actually the right time to be thinking about what we could actually do to help central banks in balancing their multiple objectives. And I will conclude by saying some points on that. So with respect to the contours of progress, a good starting point is to look at outcomes with respect to price stability, and financial deepening. Many of you know these outcomes, and what we've already heard is that central banks had big problems in achieving these three goals, but over the past decades, this performance has been improved. So inflation rates have been declining. Median inflation or average inflation has declined in Kenya, Nigeria, and Uganda, and this is a trend. This is a wider trend across Africa. Similarly, the incidence of banking crisis has declined. So what you see here is the number of countries experiencing a systemic banking crisis for each year. And this number has been very high in the 1980s and 1990s, but it's been very low in the 2000s. So there's actually only one country which experienced a systemic banking crisis, and that was Nigeria in 2009. And a similar performance you find if you look at another indicator for financial stability, that's the ratio of non-performing loans to total loans. So in general, there is a decline in non-performing loans, with the exception of Nigeria again, where there was a huge surge in non-performing loans in 2009, 2010. But in general, over the past, since the mid-2000s, this ratio has declined. And this performance is remarkable because what we see here is that domestic credit has been rising over the same period. So there has been a positive trend in lending to the private sector. And but while these performance indicators are a good starting point to capture the progress central banks have made in balancing their multiple objectives, it's also important to look at the policies because price stability, and financial deepening are driven by a myriad of factors outside the control of central banks. So to actually understand in what extent the central banks have made progress in balancing their multiple objectives, it's important to look at the policies which underpin these outcomes. And it's good to start with a backward glance and to compare the period before the reforms to the period when central banks actually reformed their policies. So in the time between the 1960s up to the 1980s, 1990s, when countries then embarked on structural adjustment reforms, many central banks were pursuing developmental central bank policies. And while there was a huge variation across Africa, on balance, it's quite accurate to describe these policies as more focused towards providing financial resources towards the state and the private sector than towards guarding price and financial stability. And in recent years, this has changed. So monetary policy has been reoriented towards guarding price stability. A good example in this respect is Uganda, where since the 1990s, price stability has become the major policy priority of the central bank. And this is also reflected, for instance, in the move to inflation targeting in 2011. Less extensive was this progress in Nigeria, where the central bank is now targeting inflation, but it also pursues other goals, like, for instance, exchange rate stability, or it also targets credit growth. And there was also improvement in with respect to regulation and supervision. So, for instance, in Kenya, these improvements have been, or these reforms have been quite continuous. More recent has this progress been in Nigeria, when the country experiences banking crisis, and it then massively tightened its regulation. And then, since the mid-2000s, the country has also employed reforms with the view to develop financial markets. So Kenya, for instance, has earned a reputation for proportionate regulation, as in the case of mobile banking, and most continuity with respect to its policies in developing the financial sector is in Nigeria, where the central bank essentially still maintains a role as a development finance institution by operating various schemes in development financing. So what has driven this progress? Actually, we don't know much about what has driven this progress so far because, as I said already, the literature on the trade-offs between price stability, and financial deepening is only emerging at the moment. So most research has been concerned with the relationships between policies to pursue each of the three goals. But we can get some hints on what has driven these policy reforms by looking at the literature on the political economy. And I'll focus on 5 factors. That is leadership, crisis, the susceptibility to the demands from important providers of financial resources, domestic pressure for more broad-based growth, and ideas on social learning. And I focus on these 5 factors because they have been highlighted in political economy literature as very important instigators of reform, and because they seem to be related to reforms in Kenya, Nigeria, and Uganda, as the interview suggests, and as also case studies suggest from the countries. And but it's clear that this list, of course, is not exhaustive, but I cannot cover all the factors which might have driven these policy reforms here. So looking at the first factor, which is leadership. So policymakers and donors often attribute reforms to leadership. And leadership indeed appears to have been driven central bank policy reforms in Kenya, Nigeria, and Uganda. So in Kenya, for instance, the governor has earned a reputation as a champion of financial inclusion, and he leads many initiatives in this area. In Nigeria, the governor has been hailed for using insider knowledge and to resolve the banking crisis, and he took very contested actions to resolve the banking crisis in 2009. In Uganda, the governor has a reputation as an advocate of stability, and actually the central bank policy has been really very much informed by his policy stance, which by his policy preferences, which prioritize price stability and financial stability over other goals. But it's also important to acknowledge that the role of leadership is mediated by economic and political factors. So for instance, in Kenya, a benign economic environment with a very dynamic private sector and relative price and financial stability was very conducive to the governor's exercise of leadership. And it's also important to acknowledge that leadership actually is endogenous. So in many African countries as elsewhere, the central bank governors are appointed by the president. And usually central banks would only pick a central bank governor who has leadership potential if they actually want an authoritative central bank. And the case of Nigeria illustrates this quite well, where the central bank governor really exercised leadership in resolving the crisis with the political backing of the president to do whatever it takes to restore financial stability. But this year the governor was dismissed by the president from office when he charged that billions of dollars were missing from the central bank's account from oil revenues. So it's important to recognize that leadership will be important to sustain central bank's progress in balancing their multiple objectives in developing countries, but it's definitely not sufficient to sustain progress. So with respect to the prospects of sustaining progress, it's important to recognize that leadership actually rests on the political will for reform or to sustain reforms. There's also recurrent supposition in the political economy literature that crisis is a driver of reform, and crisis indeed appears related to stabilization reforms in Kenya, Nigeria, and Uganda. So in Kenya, Kenya experienced a prolonged economic decline during the 1990s, which then induced a regime change and a change in the economic ministers, and subsequently central bank policy was reformed. In Nigeria, financial reforms also took place in response to the financial crisis in 2009. And in Uganda, there was a prolonged economic decline during the 1980s and 1990s, during the 1970s and 1980s, and this strengthened the influence of donors who provided aid in exchange for economic reforms, and of reformers, because the crisis lent credence to the arguments of reformers. It's not quite clear what the policy implication of that is, because we actually do not know how to sustain progress without experiencing further crises. However, there is evidence that as time passes and the crisis memory fades, policymakers become less concerned about guarding stability. And so with respect to the prospects for sustaining central bank's progress and balancing their multiple objectives, it's important to be aware that some of the factors which seem to have driven progress, like crisis, may not have a lasting effect. So it's important that policymakers become aware that there is an increasing risk of complacency as time passes. Moreover, from an analytical standpoint, this relationship between crisis and reform also raises the question why there are cross-country differences in countries' responses to crisis. Even when the crises are similarly severe. And this suggests actually that crisis responses are mediated by other factors. And one of these factors seems to be the susceptibility to the demands of important providers of financial resources. And this is an argument which comes from the literature on the political economy of finance. And the starting point of this argument is that if there are groups in an economy which control important financial resources that would help in a country to raise investments, the ability to withhold these resources provides these groups with leverage over policy. And so governments have strong incentives to pursue policies which respond to the policy preferences of those groups which are important providers of financial resources. And actually, this susceptibility to demands from providers of financial resources seems to be related to policy choices in Kenya, Nigeria, and Uganda. So what you would find in Kenya is that stabilization reforms were implemented to respond to the policy preferences of donors in the early 2000s. and also to create an environment conducive to investments by larger businesses. But at the same time, the central bank was very concerned about promoting or about having in place policies to promote financial deepening, because agriculture and the SME sector play a very important role in Kenya, and so the government was concerned about providing a policy environment conducive to growth and investment in the agricultural and SME sector. In Uganda, the private sector was not so developed at the time of stabilization reforms, but donors played a very important role. So in the 1990s, Uganda was heavily dependent on aid, and so they implemented stabilization reforms to respond to the policy preference of donors in the beginning. And in Nigeria, the situation is very different, because here the government has a wide discretion over a large amount of financial resources, which again limits the susceptibility to the demands of non-state actors like donors or even the private sector to produce particular reforms. And this explains also why some of the reforms for stabilizing the economy have been delayed in Nigeria, and why there was a continuous focus on financial development, which reflects the policy preferences of the government. So what this suggests is that central bank policy is shaped by economic structure, and with respect to the prospects of sustaining central banks' progress and balancing their multiple objectives, it suggests that having a relatively diverse private sector, as in Kenya, may be conducive to sustaining this progress that central banks have made. Donors may also play a very important role in sustaining central banks' progress, but it's important to be aware that as aid dependence wanes, so does the influence of donors. And in Uganda, we are already seeing signs of that, because aid dependence is increasing, and in recent years, central bank policy has become more expansionary. And the case of Nigeria suggests that the prospects for sustaining this progress and balancing multiple objectives in resource-dependent countries are not as bright as in other types of countries, because here it's the case that when central banks start to emphasize one objective at the expense of another, other actors outside the state, like donors or the private sector, will find it more difficult to request reforms, because the government is simply not dependent so much on them. Another factor which seems to be related to central banks' progress in balancing their multiple objectives is the increasing domestic pressure for more broad-based growth. This pressure has been increasing for a variety of reasons. So an increase in inequality, for instance, or an increase in the perceived inequality, and also the perception that, for instance, increased democratization. So it seems plausible that this pressure for more broad-based growth has also encouraged a greater focus on financial deepening among central banks. And this is in line with what previous research on the political economy of finance finds, namely that if politicians perceive enhancing growth a greater political challenge than enhancing stability, government interventions to deepen financial sectors become more likely. And the experience of Uganda is in line with the idea that this pressure for broad-based growth has encouraged greater attention to financial development. For instance, in Uganda, there has been increased political competition since the mid-2000s, and there is the widespread perception that the almost single-minded focus of the central banks on price and financial stability has failed to promote broad-based growth. And so since the mid-2000s, the government has changed its policy agenda and has now broad-based growth as an explicit target, and financial deepening is seen as a key element of this new policy agenda. And similarly in Nigeria, there is a widespread perception that oil wealth has failed to produce broad-based economic prosperity, and this has been a source of growing political tension. So policymakers, when I interview policymakers, they always emphasize that promoting financial deepening is an important means of economic diversification and supporting inclusive development. I'll skip that one and jump to the conclusion. So what can we conclude about the prospects for sustaining progress? What I've just presented is based on only 3 countries, so it's difficult so the generalizability of the findings is, of course, limited. But actually, these countries exhibit quite some variation, or part of the variation that we find across Africa, and many of the drivers of progress have been common to these 3 countries. So it's actually quite plausible that some of the lessons we can draw from Kenya, Nigeria, and Uganda apply also to other countries. And what the analysis suggests is that there is indeed no room for complacency, because some of the factors which have driven central banks' progress in balancing their multiple objectives may or may not have a lasting effect, or just a temporary effect, or the effect is mediated by other factors. We have seen it in the case of crisis or in the case of leadership. And there are also substantial challenges to sustaining progress. For instance, this domestic political pressure for broad-based growth is going to stay here for a while, and with this, the pressure on central banks to actually support broad-based growth by financial deepening is going to stay as well. Resource dependence may also pose a challenge, because these countries resource-dependent countries try to rely on financial deepening as a means of economic diversification. So it's actually the right time to be thinking about what needs to be done to support central banks in juggling their multiple objectives. And there's a final and finally some thoughts about what we could actually do. So what will be important is to identify policy reforms that either simultaneously enhance multiple objectives, that is, that policies which simultaneously enhance price stability, financial stability, and financial deepening at the same time, or to actually identify policies which promote one goal without unduly increasing risk for other goals. And there is an increasing amount of work in this area, which tries to identify such policies. A final factor or a final issue is, or something where we do not have much work on at the moment, is the question how we could support central banks in their ability actually to sustain policy reforms. And the analysis of the drivers of progress suggests some starting points. So it will be important to support leaders, but of course this won't be sufficient. Private sector development will be an important means of supporting progress, and also facilitating learning across countries through conferences, seminars, and so on will be important. An issue which I haven't mentioned and I will conclude with is the need to work towards a policy framework that acknowledges both the importance of financial deepening and the tensions between competing objectives. So in many countries, central banks have an official mandate for guarding price stability and one for guarding financial stability, but in fact what they do is they are increasingly pursuing policies to promote financial deepening. And at the same time, there are also very few countries which have a policy framework in place which addresses the tensions between multiple objectives. And Samuel Abimaimu has recently published a paper on that. So the major task will be to think about a policy framework that acknowledges the importance of financial deepening, because this pressure on central banks to support economic growth will remain for some time. And if central banks do not support governments in their activities to enhance financial deepening, they might become political targets and may risk losing their independence. But at the same time, it's important that these policy frameworks acknowledge the tensions between competing objectives, because this will help central banks to justify policy actions which actually curb financial deepening and in the interest of price and financial stability, because such actions may be politically difficult, and it's more easy to pursue them when you have a formal mandate or when it's formally documented that there are tensions between policy objectives. Thank you very much for your attention.